I've been investing for nearly a lifetime. And in that time, I've seen geniuses go broke, rich men turn poor, and empires vanish overnight. Not because they lacked intelligence, but because they lacked discipline. You don't need to be smarter than everyone else. You just need to avoid the big mistakes, the ones that quietly destroy fortunes while people are busy chasing shortcuts. One of the most predictable ways people lose money, sometimes millions, is by chasing hot tips and market trends. I've seen it happen over and over again. Someone hears a whisper from a friend, a TV pundit, or a social media influencer promising quick returns, and suddenly they're convinced they found a shortcut to wealth. It's an old story. The faces change, the technology changes, but the psychology behind it never does. People get seduced by excitement and mistake movement for progress. They'll say, "Charlie, this time it's different." But it's never different. The same forces of greed, envy, and impatience play out generation after generation. Whether it was the dot-com bubble, the housing boom, or the latest crypto craze, the pattern remains the same. People buy what they don't understand because everyone else seems to be making money from it. They call it investing, but it's really just speculation dressed up in fancy language. They're not thinking about businesses or intrinsic value. They're thinking about price. And the moment you start focusing on price instead of value, you've already started losing. The irony is that the crowd always feels safest when it's most dangerous. When everyone's rushing into something, it creates the illusion of certainty. But that's exactly when risk is highest, when everyone believes there is none. People forget that behind every great story, there's usually someone quietly selling to them. As I like to say, if you don't know who the fool is in the market, it's probably you. Real investing requires patience and understanding. It's not about excitement, it's about judgment. The best opportunities often feel uncomfortable, even boring. They don't come with fireworks or headlines. They come quietly when no one else is looking. And that's hard for most people because being patient in a noisy world feels like doing nothing. But waiting for the right pitch, that's how you build wealth. Warren and I made our money not by swinging at every ball, but by waiting for the fat pitch right over the plate. The problem is most people can't stand to wait. They want constant stimulation. They think if they're not trading, they're not progressing. But activity and achievement are not the same thing. In fact, the more you trade, the more likely you are to make emotional decisions. And emotion is the enemy of good judgment. The market is a device for transferring money from the impatient to the patient. And that's not just a clever quote, it's a law of human behavior. You have to understand something fundamental in investing. Your temperament matters more than your intellect. You can have all the IQ points in the world, but if you can't control your impulses, you're going to follow the crowd straight into the ditch. Discipline is rarer than intelligence. The ability to say, "I don't understand this, so I'll pass," is the mark of a mature investor. The world rewards those who can sit quietly with their own thoughts while others are losing their heads. If you want to avoid losing millions, stop chasing excitement. Stop believing you'll get rich by predicting the next big thing. Focus instead on understanding what you own and why you own it. Study the business, its management, its economics. Think about durability, not popularity. The best investments aren't the ones everyone's talking about. They're the ones no one needs to talk about because their value speaks for itself. In the long run, wealth belongs to the disciplined, those who resist the temptation to follow the herd, who build slowly, who understand. That compounding doesn't need noise or drama to work. Those are the people who win. You don't need to outsmart everyone else. You just need to avoid being stupid when everyone else is losing their minds. And if there's one rule you should carry with you, it's this. It's better to be boring and rich than exciting and broke. There's another pattern I've watched repeat itself, and it's responsible for more financial disasters than almost anything else. Overconfidence in good times. When markets rise, people start believing they're smarter than they really are. They think their success is skill when it's really just the tide lifting all boats. And when the tide goes out, as Warren likes to say, you see who's been swimming naked. It's human nature. When everything's going up, the brain rewards you with dopamine, that chemical rush that says you're a genius. You start to believe you have some special insight others don't. You stop questioning your assumptions. You take bigger risks, and you forget that markets are designed to humble anyone who forgets how fragile success really is. I've seen this play out in every bull market, from the roaring 90s to the crypto bubble. Ordinary people start acting like hedge fund managers, and hedge fund managers start acting like gamblers. Everyone thinks they can't lose. The truth is, bull markets breed arrogance. They create an illusion of intelligence. Even fools feel brilliant when prices rise. But success built on luck is like a house built on sand. It looks fine until the first storm hits. The markets have a brutal way of teaching humility, and that tuition is always paid in dollars. You see, most investors don't fail because they're stupid. They fail because they get drunk on success. They mistake a favorable environment for personal brilliance. When their portfolio grows, they expand their lifestyle, borrow money, double their positions, and take on more risk, all because they think the good times will keep rolling. But markets don't move in straight lines. They rise, they fall, they crush the overconfident and reward the disciplined. What's funny is that humility and patience are the least celebrated virtues in investing, yet they're the only ones that consistently protect capital. It's boring to say, I don't know what the market will do. People want predictions, not prudence. But the moment you start believing you can predict the future, you've already lost your grip on reality. No one, not even the smartest investors, can consistently forecast short-term movements. What we can do is prepare for uncertainty, build resilience, and keep our emotions under control when the crowd loses its mind. I've always believed that the biggest risk isn't market volatility, it's your own behavior. When prices rise and your portfolio looks good, that's when you're most vulnerable. That's when you start taking shortcuts, ignoring risk, and convincing yourself that this time is different. It never is. Every boo. M carries the seeds of its own collapse, planted by people who forgot how painful the last downturn was. Real investors learn to distrust euphoria. When everyone else feels unstoppable, that's when I get nervous, because history teaches that confidence peaks right before disaster. The great fortunes are made not by predicting when the storm will hit, but by staying disciplined enough to survive it when it does. You can't control markets, but you can control yourself, your expectations, your patience, your restraint. The smartest investors I've ever known weren't the loudest or the flashiest. They were quiet, rational, slightly skeptical people who always assumed they could be wrong. That mindset keeps you alive in the market. When you build a habit of humility, you don't swing wildly with the crowd. You keep cash when others are greedy. You buy value when panic sets in. You play defense when everyone else plays offense. Because in the end, investing isn't about proving how clever you are. It's about surviving long enough for compounding to work its magic. That requires a temperament that stays steady through both euphoria and despair. Overconfidence is just the market's way of testing your character. And the simple truth is this: if you can stay humble in good times, you'll still be standing when everyone else is learning humility the hard way. Another way I've seen people lose fortunes, and I mean entire fortunes, is by underestimating risk and overestimating their ability to handle debt. It's a quiet destroyer. It doesn't announce itself with fireworks. It just compounds quietly in the background until one day the bill comes due and it's too big to pay. Leverage, when misunderstood, is like handling a razor. Useful in skilled hands, deadly in careless ones. Debt gives the illusion of strength. It makes small investors feel big and turns good times into great ones until the cycle turns, and it always turns. What looks like smart financial engineering in the boom becomes reckless stupidity in the bust. I've seen people borrow against their stocks because they believed prices would keep rising. They didn't plan for a margin call. They never do. And when it came, they were forced to sell their best assets at the worst possible time. The market punishes impatience and leverage more brutally than anything else. There's a psychological trap at play here. Leverage feels empowering when you're winning. It magnifies gains, feeds your ego, makes you feel like you've found a secret formula. But the same tool that accelerates wealth can also annihilate it. People forget that the mathematics of loss are asymmetric. If you lose 50 IA, you need a 100 day gain just to get back to where you started. Add debt to that equation and recovery becomes nearly impossible. Debt doesn't just magnify risk, it multiplies stupidity. Now, I'm not saying debt is evil. Used prudently, it can be a productive tool in business and real estate and life, but there's a difference between using debt rationally and using it emotionally. Most people use it emotionally. They want to accelerate outcomes, to fast forward success, to appear richer than they are. That's not strategy. That's vanity disguised as ambition. And vanity, more than volatility, destroys wealth. The danger with risk is that it's invisible until it's too late. It builds quietly while everyone's celebrating their paper gains. People convince themselves that because nothing bad has happened yet, nothing bad will happen at all. That's the kind of thinking that precedes every collapse. Real risk management isn't about predicting when things will go wrong. It's about knowing they can and preparing for it before they do. It's about building a margin of safety into your life and your investments. When Warren and I talk about the margin of safety, it's not just a financial concept, it's a philosophical one. It's about humility. It's about acknowledging that the future is uncertain and that our judgment isn't infallible. The world doesn't owe you favorable outcomes just because you worked hard or because you believe you're right. If you leave no room for error, you're gambling, not investing. I've always said it's not the return on your capital that matters. It's the return of your capital. You have to survive first before you can prosper. People underestimate how valuable staying power is. Survival lets compounding do its job. The investor who avoids ruin, even with modest returns, will outperform the gambler who wins big and loses bigger. Wealth is not built by taking the most risk. It's built by managing it wisely over time. If there's a common thread among those who've lost millions, it's that they took risks they didn't understand and borrowed money they couldn't repay. They traded peace of mind for temporary pleasure. They learned too late that leverage gives you the illusion of control right up until you lose it. So if you want to build something that lasts, earn to respect risk. Don't borrow trouble by chasing returns you don't need. The real mark of wisdom isn't how much you make when times are good. It's how little you lose when times are bad. And if you remember nothing else from this lesson, remember this. Leverage can make you rich faster, but it can make you broke forever. Another mistake I've seen destroy fortunes is the inability to think long term. People want everything fast. Fast money, fast success, fast validation. But in investing, impatience is the silent killer. It disguises itself as ambition, yet it's really just insecurity. Most people can't stand the idea of waiting, even when time is the very thing that makes compounding possible. They want the reward, but not the process that earns it. It's almost a law of human nature. People overestimate what they can achieve in a year and underestimate what they can achieve in 10. The stock market, by design, rewards patience. It's a machine that transfers wealth from the impatient to the patient. But we live in a culture that celebrates immediacy, instant profits, overnight success stories, and quick flips. That mindset is toxic for investors because it pushes them into constant activity instead of consistent thinking. I've met many people who say, I'm in it for the long run, and then panic at the first sign of volatility. They'll say they're investors, but they behave like traders, glued to screens, reacting emotionally to every tick up or down. What they don't realize is that volatility is the price you pay for returns. You can't have one without the other. The market is designed to test your patience and your conviction. If you can't handle watching your portfolio decline without losing your mind, you don't own your investments. They own you. Thinking long-term isn't about ignoring the short term. It's about not being ruled by it. It's understanding that wealth creation is a marathon, not a sprint. Compounding is one of the most powerful forces in the universe, but it only works for those who respect time. The magic doesn't happen in year 1 or 2. It happens in year 10, 20, 30. That's when small, consistent gains snowball into something extraordinary. Yet most people interrupt compounding before it can do its work. They sell too soon, switch strategies, chase new opportunities, and end up starting over again and again. The reason people fail to think long-term is often psychological. We're wired for immediate gratification. Our ancestors had to prioritize the short term to survive, find food, find shelter, avoid danger. The modern world, however, rewards those who can reverse that instinct. The ability to delay gratification, to endure boredom, uncertainty, and waiting is one of the rarest forms of intelligence. It's not about IQ, it's about temperament. The great investors have trained their minds to find comfort in patience and discomfort in rushing. One of the best habits you can build as an investor is to view every decision through the lens of time. Ask yourself, will this matter in 10 years? If the answer is no, it's probably not worth worrying about. You don't need to check your portfolio every day. You don't need to react to every headline. You need to plant good seeds, sound businesses, reasonable valuations, and durable strategies, and then give them the time to grow. There's nothing glamorous about that, but it's how wealth actually works. And here's another truth. Slow progress is often the best kind. It's sustainable. It's grounded. It builds character along with capital. You won't always feel like you're winning when you're thinking long term because most of the payoff happens quietly below the surface. But if you stay rational, avoid noise, and keep your hands steady, time will do the heavy lifting for you. Most people lose not because they lack opportunity, but because they lack endurance. The irony is that it's easier than ever to invest, yet harder than ever to wait. Technology has made trading effortless, but wisdom is still rare. If you can cultivate patience in a world addicted to speed, you'll have an edge over almost everyone else. And if there's one sentence I could leave you with on this point, it's this: impatience will make you chase riches, but patience will quietly make you wealthy. Another great destroyer of wealth, maybe the most common of all, is the failure to understand human psychology, especially your own. The biggest enemy of an investor isn't the market or inflation or even bad luck. It's the person in the mirror, your brain, your emotions, your biases. Those are what cause the real damage. The market doesn't care about your feelings, but your feelings care very much about the market. And that's where people get hurt. I've watched otherwise intelligent people fall apart in moments of greed or fear. They'll spend years studying financial models and not 5 minutes studying their own behavior. It's astonishing. They think they can outsmart the system, but they can't even outsmart themselves. They panic when prices fall and get euphoric when they rise, precisely the opposite of what rational behavior would dictate. They sell low, buy high, and then tell themselves a story about why it made sense at the time. The human mind is a brilliant justifying machine. Understanding psychology is essential because markets are reflections of it. Prices move not because of perfect information, but because of collective emotion, optimism, pessimism, greed, envy, and fear, cycling endlessly. If you can stay calm while others are being ruled by these forces, you'll have a permanent advantage. But calmness doesn't come from luck. It comes from preparation, from knowing who you are and what you own, and from accepting that volatility is part of the journey, not a signal to run. One of the most dangerous biases is overconfidence. People consistently overestimate their ability to predict the future and underestimate how they don't know. They'll take 1 or 2 good outcomes as evidence that they've found a formula. That's not rationality. That's ego wearing a lab coat. Real wisdom comes from humility, from the willingness to say, I don't know. The world is far too complex to be mastered by certainty. You have to build systems that work even when you're wrong, because you will be wrong, often. Then there's envy. Envy is a particularly corrosive force in investing. You see someone make a fortune overnight, and suddenly your steady progress feels inadequate. You start chasing what they have, not realizing that most of what they have is temporary. Envy drives people to abandon sound strategies for exciting ones, to take risks they don't understand, and to measure success by comparison instead of by consistency. It's an endless trap. As I've said before, envy is a really stupid sin because it's the only one you can never enjoy. Fear is another powerful one. Fear makes people sell at the worst possible time. It makes them mistake short-term pain for permanent loss. The irony is that fear feels like prudence, but it's often just disguised panic. The key is to recognize fear as a natural emotion, not an instruction. You can feel fear and still choose to act rationally. That's what separates professionals from amateurs, not the absence of emotion, but mastery over it. At its core, successful investing is about temperament. You don't need brilliance, but you do need stability. The ability to stay rational when the world loses its head. That's your edge. If you can keep your emotions from dictating your decisions, you'll beat the vast majority of people over time, not because you're smarter, but because you're steadier. I've always said that rationality is the ultimate advantage. Intelligence can fail you, trends can fool you, markets can humble you, but rationality, the ability to think clearly in the face of chaos, that's what keeps you alive. So if you want to survive in this Smee, stop trying to outsmart everyone else and start trying to out-discipline yourself. The real battleground isn't on Wall Street. It's in your own head. And the truth I've learned after a lifetime of watching investors rise and fall is simple. The person who masters their mind will never be mastered by the market. There's one more mistake I've seen ruin investors, and it's deceptively simple. People don't appreciate the power of simplicity. They think success has to be complicated, that wisdom must come wrapped in complexity, with charts, models, or formulas no one can understand. But the truth is, the most powerful ideas in investing and in life are almost always simple. Not easy, but simple. I've spent a lifetime watching people try to outsmart simplicity. They think if something sounds complicated, it must be sophisticated. They confuse obscurity with intelligence. And the financial world feeds that illusion. There's a whole industry built on making things look more complex. They are because complexity sells. It gives people the feeling of control. But real control, real mastery comes from clarity, from understanding the fundamentals so deeply that you don't need to hide behind jargon. When Warren and I started investing, we didn't need 50 screens or fancy derivatives. We looked for good businesses run by honest people, selling at fair prices. That's about as simple as it gets. Yet people still can't bring themselves to do it. They want to believe there's a shortcut, a secret, a hidden formula. But the hard truth is there isn't. The world rewards those who can do the simple things consistently well, not those who chase complexity for its own sake. There's also a psychological reason people avoid simplicity. It feels almost insulting to the ego. Everyone wants to feel exceptional. They want to believe they're operating on some higher intellectual plane. So they create layers of unnecessary complication to prove their sophistication. And in THE process, they lose sight of what actually matters. Simplicity demands humility. It forces you to admit that most of what's out there is noise, and that's hard for the ego to accept. In my experience, the investors who do best are the ones who deliberately keep things simple. They build frameworks that are easy to understand and hard to break. They don't overtrade. They don't chase the latest financial innovations. They stick to what they know and they repeat what works. You don't need to reinvent the wheel to become wealthy. You just need to keep it turning slowly over a long period of time. Simplicity also has a moral component. When you simplify, you strip away illusion, and illusion is what leads people into trouble. Complexity allows people to rationalize bad behavior. They tell themselves, it's okay because the model says so. But the model is only as good as the assumptions behind it. Simplicity forces you to confront reality. It makes you see things as they are, not as why. Wish they were. That's what rationality really means. cleverness, but clarity. You'll find that the best ideas in business, in investing, in life, tend to rhyme with common sense. Spend less than you earn. Invest in what you understand. Be patient. Avoid debt. Work with people you trust. These are not secrets. They're principles so simple they get ignored. But if you actually live by them, you'll outperform 90% of the population. Not because you're smarter, but because you're less self-destructive. The irony is that the pursuit of complexity often leads to fragility. Systems that are over-designed, strategies that are too intricate, they fail when the unexpected happens. Simple systems endure because they're adaptable. The same applies to people. The investor who sticks to a few timeless principles will survive the chaos that destroys everyone else chasing novelty. Simplicity requires discipline. It means saying no to distraction, no to unnecessary risk, and no to the constant temptation to be clever. It's not glamorous. It won't impress at cocktail parties, but it works. And in the long run, that's all that matters. If there's one thing I've learned after all these years, it's that the road to wealth isn't hidden. It's just ignored. People keep searching for magic when the truth is right in front of them. And I'll leave you with this. Complexity may look smart, but simplicity builds empires. The truth is, you don't have to be extraordinary to build wealth. You just need to avoid the ordinary mistakes. Avoid hype, control your emotions, manage risk, and think long term. That's how you survive in this game. Remember what I always say, it's not supposed to be easy. If it were, everyone would be rich. But the beauty of discipline is that it compounds, just like your money should.